it's also indicative of the inflationary environment. The fact that they are adjusting pay higher, I think, 10% or so. I mean, it's not something that you can just give back. So how does that play into your view of which stocks to own? It's also interesting that Deere is going up today despite those higher costs and just the overall environment.
Well, right, Sarah, absolutely. Companies have actually been able to pass on the increased cost to consumers to this point, so they have had pricing power, and so it has not been as much of a problem as it might be. But certainly inflation is going higher, and we expect the wage inflation to stay intact. I think it's one of the risks that you're going to see in 2022 begin to hit the market, and the market probably will begin to moderate. But for now, companies have been able to handle the price increase, and consumers have been willing to pay the additional costs.
Financials, one of the top performing sectors so far this year. And Chris, you brought along a chart that dives into that in a bit more detail.
Yeah, well, it really speaks to the idea that the move in financials and banks in particular is simply really, really broad. What I'm showing you here is the percentage of financials that are making 3-month highs. I mean, this is as good as we've seen really all year. So you've seen a surge in financial new highs. When you backtest that historically, the forward results are actually really quite good. It speaks to the idea that the move is broad. We see it with the banks in particular. The new high data, particularly as you go down the cap scale, is as good as anything we've seen in the sector really in months. So we look to an expanding new high list as a sign that participation is broad. It tends to mean good things for forward returns from here.
How crucial is it, Chris, that yields keep rising for that to continue? And what are the charts saying on that front?
You know, I think in a lot of respects, that relationship between yields and financials is actually deteriorating here a little bit. And we saw it all spring and summer, right? We saw bond yields go from 175 back to 112, and financials held in there great. And conversely, the groups you would have expected to have done well, utilities and staples, did nothing at all. So I just wonder, and we've talked about this in our work, in an environment where the CPI is over 3, maybe the relationship between financials and bond yields is very different than in an environment where CPI is less than 2. And that's a regime change that we've been writing a lot about. I think financials actually serve themselves as a very defensive group here. We saw that all spring and summer. I think we continue to see that right now.
Are you a buyer, Eugene, of the financials? It's second best performing sector now in the S&P for the year, up 36%.
I am. We own Goldman Sachs, and I think we are a little bit more partial to asset management, trade, and investment banking. That's been very powerful over the course of this year. I mean, if you look today, Franklin Resources, asset management, I think is up over 10%. So that's another good play in the financial sector. We're not really playing the sector for net interest rate margins, so I think that ties in to what Chris is mentioning.
Are you fearful of the capital markets aspects, Eugene, kind of turning a corner next year? It's been so hot.
Yeah, I am. I think that that's why you've seen such a growth in Goldman Sachs or Morgan Stanley. And certainly, whether you're talking about SPACs, whether you're talking about just overall IPOs coming to the market, that's going to stop at some point. I think that's when you hear commentary around a bubble environment. That's some of the areas where it is. But I don't think that the banks will fall off a cliff as a result, and most market participants are only looking at interest rate increases as an issue. I think what you mentioned about capital markets is much more of an issue.
Chris, as we head into the close here, 2 minutes to go, the Russell 2000 small caps really stand out, up 2.65% today. Part of it is just what's working in the market, like energy and more cyclical names, materials. But talk about how the technicals look for the Russell, which has lagged overall.
Yeah, I mean, Russell, too, peaked in March, right? So no one's made money in the small cap trade in 8 months. We think that's changing here. If you look at the calendar, really seasonality sets up great for small caps, really through about November into spring. So we have that at our kind of tailwind here. Also, the sector makeup of the Russell, too, is simply more pro-cyclical. And, you just wonder, you're getting the strength out of small caps today. What does it argue is the message out of DC, perhaps? What does it argue is the message about global risk? Are some of those risks receding here? I think that's the take from small caps here. We like them long. We've been advocating for this. I think this breakout is a very, very big deal.